So yeah, by now it's the 6th of November, and with just about roughly 9 days left, you will be writing your exam on the 15th of November. So I decided to start off our class today with some information on the exam, because I know this type of information always, well, students are always asking for this type of administrative information. And generally, us as tutors, we get very limited information. We get what you get. But I've managed to just answer a few of the questions on the slide, and I just want to go through it with you, and you can ask me any questions on it. The exam date is on the 15th of November. You will be taking the exam in the afternoon at 2 o'clock. The exam opens at 1:45, and I encourage all of you to log in at that time, just to iron out any problems you're having with network, just to get comfortable on the exam portal. It's always a safe option to log in earlier and make sure everything is okay so that you can take your exam. When you're taking your exam, it just minimizes any glitches you could possibly have. And it is opening 15 minutes earlier, so make use of that and log in and start getting prepared to take the exam. So the venue for the exam is my exam portal. So for the last few years that investment management has been an online exam, we used to take the exam on the My UNISA platform, which never really worked out. The My Exam portal is definitely a much better platform. It will handle the volume of people as well as the volume of people, as well as the I think it's structured for an exam, for exam purposes, as opposed to My UNISA. And then the duration of the exam is 2 hours and 30 minutes. So 2.5 hours you have to take the exam. You'll be examined on 40 multiple choice questions, and the questions are from unit 1 to 15 in your study guide, textbook, and study material. We're excluding unit 4, which is time value of money.
There's a hand up, Yamuna.
Oh, there's a hand up. Okay, you can go ahead. You can ask a question.
Thank you. Yumna, I'm not sure if you presenting. I think your slides are not moving.
I'm on one slide. Do you see exam information?
No, we're still on the intro slide.
Is everybody still on the intro slide?
Yeah, we are still on the intro slide, on the first slide.
Okay. So I'm not too sure.
Maybe reshare.
Reshare, okay.
Stop sharing and then reshare, maybe it will come.
All right.
Yeah, now we are on.
We're on. Okay, so if I go back to slideshow from current slide, how's it looking now? Are we on exam information?
Yeah, we are on exam information.
Okay, sorry about that. Sorry about that. I was unaware of that. Thanks for bringing it to my attention. So now we're on the exam information slide. As I go ahead, you can just indicate to me if the slides are moving. So we're on the first slide. So I'd like to open our discussion today with exam information, and we can answer any questions, and then we can go ahead with the study material. So what I've spoken about is just the first part, which is written in black, which is on My UNISA. It's all the information we've given already, but I'm just reassuring you that that's all the correct information. And then I wanted to move on from my side, from previous experience. What I'd like to tell you guys is that make sure you have secure internet connection. And I'm sure you're taking all your exams online, so you guys also have some good experience. But a secure internet connection, even if it means going to get some additional data, or going to a venue which has internet, a good secure internet line or internet connection, will be advisable from my side. And the next tip I have is that please use a computer and not a mobile phone. I wouldn't even suggest a tab. I'm not so familiar with a tab, but what happens is that the mobile view versus the computer view, it's a little bit different, and you might not get the questions completely written down, or there could always be a problem with the mobile view, because the exam, I think, is, or like this platform, I think, is structured for a computer. So please try and make provisions to be taking your exam on a computer. You'll be able to answer much better, and the questions will appear clear and more concise. That's my advice from my side with regards to that. And then I have been telling you guys, and I've just gotten confirmation from the lecturer, make a formula sheet. I'm not saying make 5 pages of copy notes. No, I'm not saying that. You don't have time to look through your notes, copy notes, and it will confuse you during the exam. And obviously, that's the last thing I'd advise. I'd say learn the work and know the work. But a formula sheet, I think it's important, because just to reassure yourself before you doing the answer. So you start off with chapter 1, with unit 1, and in unit 1 we have the following possible questions. So you put down your HBR formula, your HBY formula, standard deviation. The formula is quite complicated, but put down like a formula for yourself, a standard deviation, because those are the possible calculations which you'll have in unit 1. Go to unit 2, look at the possible calculations, put your formula down so that you know, or you can double check when substituting into the formula. So make a formula sheet from unit 1 right up until unit 15. Unit 1, unit 3, unit 5, unit 11, unit 12, unit 13, 14 and 15 all have formulas in them. They all are calculation based. Write down your formulas, and it can really help you when going through this exam. And don't forget to bring along your financial calculator, especially for unit 12 for bonds. I think a financial calculator is the easier way to calculate. And yeah, like I wouldn't advise opening up a calculator on your computer, which is also possible, but just make sure you know how to operate things and opening and closing windows and so forth. But for me, a financial calculator is very important for unit 12, and for every other unit you can use it for your calculations. And yeah, so these are my tips. If any of you have any questions, you can ask me, and then we can go ahead to the practice for the exam.
Hi, sorry.
Yes.
I have a question. So I've attempted the exam on the My Exam portal.
Yes.
I've noticed that feedback has been disabled. It's very difficult to navigate through the exam and remember exactly what I chose, and then to go back in and look at the answers that has been uploaded onto the My Unisa site. Is there a way that you would be able to activate the feedback icon on the exam?
To activate the feedback icon.
Yeah.
Okay, so I'm actually not familiar at all with the exam portal, but I will put a request in for you. Like according to me, like generally this multiple choice question, you get a question per page, and then you can save the question, and then you can go, before you close the exam, you can go back and forth. It's like 40 questions, and just go and check. So then I would say my best advice to you, if we do not get this feedback activated, but I definitely will put in a request, is that do the entire exam up until question 40. Keep on going forward, or keep or go backwards. So what I would say to you is that when you're coming to recheck, so you complete the exam up until question 40. Now there were certain questions inside there which you didn't answer or you were not so sure. Make a note of them down. But then start right from question 1. Have a look, see has question 1 been answered correctly and has it been saved. I feel like you'll have enough time, but if you do not have enough time, you always have your notes, which you said I'll come back to. Question 11, I said I'll come back to. Don't rush through your exam, make these notes on these certain questions on your piece of paper, and then you can always go back to those questions. But definitely, I will try and make a request for the feedback to be activated. Okay, is that okay? Any other questions?
Yumuna, my question is, do they get an opportunity to practice what the platform looks like with the practice exam?
I'm not too sure if the practice exam is on the My Exam portal, but I do know Mr. Matsoma has uploaded some practice material on the My UNISA site, and generally I'm sure the exam and this practice paper it should be quite similar.
So it will be good advice for everyone to just go and take the practice paper so that they are ready.
Definitely. Once you're confident and we've done these revision classes and you've gone through assignment 1, assignment 2, and your study guide questions, go and use this exam as a test for yourself, in terms of navigating through a question paper, in terms of testing your knowledge, and test out your computer and your internet connection as well. I'm sure it will all contribute positively.
Mojaki has a question there.
Yes, Mojaki. Does the exam require Invigilator app?
Good morning.
You must just... Yes.
Okay, I just
I'm sorry, can I just answer this? Okay, sorry, does the exam require Invigilator app? I must find out, but I'm sure all your exams taken on My Exam portal requires Invigilator app. Okay, yes, there is. Okay, so there's some advice on the chat as well about navigating through the paper, but you can go ahead with your question.
Good morning.
Good morning.
I just want to find out, is the exam paper going to be separated into 2 sections, or is just 1 to 40 questions?
One paper. 1 to 40 questions. Normally the sections happen when we have longer type questions where you will be asked to type out answers or write answers. But we are doing this module only asks multiple choice, 1 to 40.
Okay. Thank you.
All right. Okay, so they said Invigilator app is only for 3rd year. That's what Desiree is saying. So like, I can find out, like I'm saying, we have minimal information with regards to admin, but these type of admin queries will always be communicated to you before you take the exam on my portal. Just check your email, check your notifications on My UNISA. You should be given this information, and you can even put it for us on the discussion forum just to reassure the rest of the group. Okay, thank you. And the mock exam is uploaded. I did receive an email saying that it is uploaded. So please go to the My UNISA site, and I think it should be at self-assessments, if I'm not mistaken. But please have a look, and I will also try and go on the site today and just outline a few areas for you to take note of.
There's a link there, Yumuna, and also we have a few hands which are up.
Okay, so
there is the Nobu here whose hand is up.
Okay, Nobushka, you can go ahead.
Hello, how are you, ma'am?
I'm well, how are you?
I'm fine. So I want to know that the exam, it's a downloadable paper, or we just click on the correct answer?
No, it's definitely a live paper. Nothing's downloadable. You have to click on the correct answers.
Okay, thank you.
Okay. Um, okay, is there anyone else who has a question? If you guys can look at the chat, a few of the students have been putting up information. You can go through it and you can ask any questions, or you can go through it. It's some good information for you guys with regards to Invigilator and with regards to the self-assessment mock exam. Okay. All right, so let's go ahead. I'm hoping to finish at least 5 minutes earlier. I didn't realize that my daughter has sports today, and I think I should attend. But yes, let's first get you guys prepared for investment management. Okay, so have I gone on to the first slide, which says question 1? If you can just give me a thumbs up in the chat.
Not yet, not yet,
yet.
my side. Yeah.
Okay, I'm gonna just try and go out and reshare.
Okay, that was there. That was there.
Okay, but can I? It seems like my slideshow is not appearing on the. Like I wanted to work with the slideshow. Should I try and reshare?
Yeah, maybe try to reshare, maybe to help.
Okay. So, yeah. Okay, so John, if you can just, I have to first open up onto the desktop my presentation, and then when I get here to Teams, I share it.
Yes, then share the screen. That will be the easiest.
Okay. Okay, here we go.
It's coming, yeah. We can see the slides.
Okay, let me try a slideshow here.
Yeah.
Okay, is it, are we on question 1?
No, we are on the first slide.
First slide. Okay, I'm not too sure. Okay, let me try and just do it manually, I guess. Should I do it this way?
Yeah. Okay, let's do it that way so that we can move. Otherwise,
Okay.
we'll run out of
All
time.
right, sorry about that.
Okay,
I think I should have practiced. Okay, so here we have question 1. The expected rate of inflation is 5% and the real risk-free rate is 8%. Calculate the nominal risk-free rate, right? So today I'm covering chapter 1, 13, 15, 14 and 15. So this is obviously from chapter 1. It's a simple calculation to start with. If you guys can go ahead and post your answers for me in the chat, and then we can go ahead to the solution. Okay, people are doing quite well here, answering quickly. Okay, so I have a few answers, and this is a simple calculation. So let's go to the solution, right? So most of you were correct. The answer is option 3, 13.4. And how do we get that? If we look at this side here, we have the nominal risk-free rate is equal to 1 plus the real risk-free rate, right? Which is given to us, real risk-free rate. So 1 plus 8% is 1,08, right? Times by 1 plus the inflation rate. So the inflation rate was given to us at 5%. So you always add 1, you multiply together real risk-free rate, you multiply it by the inflation rate, you subtract the 1 you added in the beginning, you times by 100 to get the percentage, right? So it's 13.4%. So, you know, most likely you're going to get a question on nominal or risk-free rate. It will be converting from nominal to risk-free, or to find one subject of the formula, right? So this is an important formula. Put it down on your formula sheet. And this is a more than likely question that can be asked. However, remember, you're getting asked from a question bank, so everyone's getting asked different questions. So yes, but this is an important formula to understand nominal risk-free rate versus real risk-free rate, right? So let's move on to the question 2, right? So we said we're going to assist you guys with a little bit of theory, because generally throughout our lessons we've been focusing on calculations, which you need more help on. But I strongly feel, especially from my side, we lack on theory, and the paper does have like 25 to 30% are theory questions, right? So the South African Reserve Bank expects the anticipated inflation rate to be significantly higher due to rising oil prices. So now this is what we're currently experiencing, but anyway, what tool should we use to reduce inflation, right? What should be used by the government, right? Should they lower the repo rate? If they lower the repo rate, we're going to spend more, right? Should they purchase additional government securities? If they give us money back by purchasing the securities, we'll have more money and we'll spend more. Reducing the reserve requirement, or selling previously bought government securities, right? So taking away money from people, less spending. You guys can decide what would be the answer. So you can actually see the answers. I really need to get the slideshow working.
So, Lumna, for your slideshow, I
Yes.
think next to bottom right corner,
Yeah.
to 84%, there's a third button on the left of 84%. Press, I think it will go.
Oh, okay. I must put it to for the
No.
slideshow.
Yeah, next to, on the left of 84%, on the left. Yeah,
Yes.
that one. Yes.
Okay, let me try there. Okay. Right. Let's see. Does it go to the solution? Did you get to the solution?
No, it's not moving.
No, it's yeah.
Okay, but let me just, you know what I'll do is, as I go to the next, I'll just go to slideshow like this. Okay, so sorry, I hope you guys don't feel I'm moving too fast, but so the answer would be selling previously bought government securities, right? So why is that? Is because if the government sells bonds to us, we'll give our money to the government and we have less money to spend. It's more into saving, and it might decrease the inflation rate, right? So that's the reason for the answer. And now let's go to the next question, question 3, right? question 3 and slideshow it. Okay, so here we have another calculation from Unit 1, which is the annual holding period yield for the investment. For an investment that was held for 5 years is 4.56%. The ending value of this investment was 1,500. Calculate the beginning value, right? So in a question like this, you can see now when it comes to the exam, you're going to get a little bit complicated. Nobody's going to ask you calculate the HPR or give you the HPR and say calculate the HPY. So now we have a little bit of a complex calculation. It's going to be a two-step calculation using your HPR and HPY formula. So if you can go ahead and then we can go to the answer. And you guys can ask any questions, like say, okay, but how do I approach it while the question is on? I don't mind answering. And I forgot to thank you for the help with regards to the slideshow. Thank you very much. Okay, so this one is taking you guys a while, eh? Any takers, any answers? Okay, Lufuno has answered option 1. Thank you, Lufuno. Lindiwe also option 1. Okay, so just for a tip to get more answers in, we've been given two values, right? We've been given our HPY, our holding period yield. So you say HPY and you put the formula next to it. Our HPY formula is HPR minus 1, right? So we can easily get our HPR in that way there, right? So HPY, from HPY we can get our HPR. And what is our HPR? It is the ending value of the investment over the beginning value of the investment, right? So now we've been given the ending value, we need to find the beginning value, and we've just found out our HPR, right? So let's see, we got a mix of option 1 and option 2 here. Let's give it a minute and we can go to the formula, but I hope you understood my explanation. We've been given HPY We know how to get HBR from HBY, right? We substitute into the formula, right? So we say HPY plus 1 will give you HBR, right? And then we say HBR is equal to your ending value of your investment over your beginning value of your investment. Oh, we even have option 3. Okay, let's go to the solution, right? Okay, solution. So it is option 1. Let's see how we got option 1, right? Okay, so the annualized HPR is to the power 1 over 5. So we needed to take into account this 5 years, right? So we say our HPR is equal to my ending value over my beginning value, right? So we've been given ending value, right? We need to find out our beginning value, right? So we say annual HPY, right? So we look at our annual HPY, which is equal to our HPR to the power 1 over N, right? So they gave us our annual HPY, right? We put our 1 here, like we said, we add our 1. We take into account our number of years, right? 1 over 5, 0,2, right? Once we take it over to the side here, we times by 5, we times by 5. It turns into exponent of 5. You know how we do exponents? Let me just get my pointer out here. Okay, so here we have 1 over 5, right? So now we need to take it over to the side here. So what do? We times by 5 on this side and it disappears. We times by 5 on this side, so we have an exponent of 5 because our years are 5. So we say 1.0456 to the power 5 gives you 1.25, right? So now we got our annual HPY. 1.25 is equal to X, which is equal to my ending value over my beginning value. So we substitute and we solve for our beginning value, which is 1500 over 1.25, 1200. So that's how you get your beginning value. Okay, so is everyone okay? Would it be wrong if we just moved back by just using time value of money? I don't think it would work out using time value of money. Did you try it out? Because time value of money, there's some compounding in there. So did you try it, Siso?
Yeah, I tried
work out?
Yubuna, I tried it. It works. If you say
Oh, it
your
works. Okay.
end value divided by 1.045 to the power of 5, it will work.
Okay, all right. So thank you for that, Sibusi. So I never looked at it from a time value of money perspective, but that's good. Thank you very much for that option. Okay, great. So is everyone okay with this question on holding period yield, holding period return, annualized holding period? Okay, so let's go to question 4, which is a general theory question as well. It has some numbers in it, but it is a theory question. So in the book, there would be some sections on market orders, stop loss orders, different types of methods to hedge your investments. And this one says, if you place a stop loss order to sell 500 Renaissance, is there a question? Okay, so if you place a stop loss order to sell 500 Renaissance capital at 115 Rand, when the current price is 120 Rand, how much will you receive for each, if each share drops to 110 Rand? So you guys basically need to know, what do we use a stop loss order for? Is it to, how do we hedge using a stop loss order? And you choose your answer from there. Okay, any more answers? Stop loss order, Google quickly stop loss order, but we're not going to have Google with us on the exam. Okay, so that would be the correct answer, option 2. So basically a stop loss order protects you from the price drop, because you want to sell at, you're locking in the price you want to sell at. So if we look here, we say stop loss order is a protective measure to buy or sell at a certain price. So he wants to sell, and now the price has dropped to 110 Rand, but luckily he had a stop loss order for 115 Rand, so he gets to spend 15 Rand, right? And if you look on the other side, there will be another person who wanted to buy Renaissance but didn't want to buy it at 120 Rand, so he locked in the price. That's how these investments, these protective measures work. There'll be one person who doesn't want to buy high and another person who doesn't want to sell low. So they lock in a price with these instruments, right? So that's a stop loss order. So let's go to question 5. So appreciation of a currency, right? So that's appreciation, is the strengthening of the currency in a country, can be, is it attributed to which of the following aspects? All right, can it be the rapid growth of income, lower inflation rates, higher domestic interest rates relative to trading partners? Or is it the rapid growth of income, higher inflation rates, lower domestic interest rates relative to trading partners? Or is it a slow growth of income, higher inflation, lower domestic interest rates? Or is it a slow, steady growth of income, lower inflation rates, and higher domestic real interest rates relative to partners? So what can we attribute? How will a country's currency appreciate? What methods can we use, or when you use these methods, what the currency appreciates? Okay, so let's go to the answer of this one. Okay, so we got many different answers. Let's look at what was the correct one. Okay, so for a currency to appreciate, right, we want a slow growth of income. It maybe they're meaning steady growth of income, right, but not anything rapid, right? What goes up must come down. So we want a slower is a more steady growth of income, rate of growth of income, lower inflation rates, obviously, right, and high domestic real interest rates relative to trade partners, right? So these are all aspects which contribute to the appreciation of currency. Okay, so let's go to our next question. Okay, so let's go back to also a little bit of theory, but also understanding your figures, right? So now we're moving on to question 6, which is on unit 13, which is arbitrage opportunities, right? So, you know, we look at the market price versus the theoretical price, and we determine the appropriate arbitrage strategy, right? We have two arbitrage strategies, which is your reverse arbitrage and your cash and carry arbitrage, right? So in this case here, we have a 6 months futures contract entered into with a non-dividend paying share with a market price of 105 Rand, right? The theoretical price is calculated to be 102 Rand. So your market price is greater than your theoretical price. So determine the appropriate arbitrage strategy that will earn an arbitrage profit, right? So my tip for this one here is you always compare your market price with your theoretical price, and from there you determine your strategy, right? So remember, we have two strategies, cash and carry, and, well, these are the what happens in each of them, but we have two of them. So now when you see between your market price and your spot and your theoretical price, which is the higher one, you will determine your strategy from there. Okay, so at least most of you are on par with our arbitrage strategies. So this would be a cash and carry arbitrage when your market price is greater than your futures price. What do? You do cash and carry arbitrage, right? So you sell futures contracts, right? And you borrow money to buy, and you buy at spot, right? So let's go to the answer. Question 6. There we go. Right? So the market price is 105 Rand, greater than the theoretical price. So this is our cash and carry arbitrage situation, right? So I think everyone is familiar with that. My advice to you is look at this. We are going to have two situations where the market price is greater or the market price is less. Two strategies that we employ, right? So this is how we can get our arbitrage opportunities. So let's go to question 7. Okay, so now let's do some calculations regarding derivatives. Susan bought shares at Hollard Corporation. The share has a market price of 75 Rand and a strike price of 60 Rand. She also bought a call premium at 3 Rand. Calculate the break-even point and profit to the call holder if the market price increases to 80 Rand, right? So the first calculation you're going to do here is calculating the break-even point, where we won't make any profit or loss, right? And from there you can calculate the profit, because the market price is now increased to 80 Rand. So if you can do those two calculations for me and put your answer down in the chat. Okay, Sibasiso is asking for the recording. I'm not sure if we started recording. Have we started recording, John? Have we started recording?
Yes, we started recording. We're at 9 o'clock, exactly when we started.
Okay, great. So Sibasiso, it is recorded. So the recording will be available online. Sorry about load shedding. We all are being affected. Okay, so we can go ahead with our calculation. Okay, so we have option 3. Let's look at the answer. Okay, you guys were right. So our break-even point is our strike price plus our call premium, 63 Rand. And now the profit that we've made, because we've only paid 3 Rand and we've locked in the strike price at 80 Rand, our profit is going to be 17 Rand. Okay, great stuff. Let's move on to question 8. So here we have a European call and put option of Fitch Investments. Both have the same strike price of 40 Rand and the time to expiry is 3 months. The call option trades at 5 Rand and the put option trades at 1 Rand 50. The risk-free rate is 12% and the current share price is 45 Rand. Calculate the arbitrage profit that will be realized. So we can use our put call parity to gain our arbitrage profit, right? So we have a formula called put call parity, which we can use to gain our arbitrage profit. So the minute you're going to see a European call option, call and put option with the same strike price, you have an interest rate, you have a time frame which is 3 months. You must know you're going to use a formula which has an interest rate component, a time component, and in this case here it would be your arbitrage. It will be your put call parity to gain your arbitrage profit or loss. Well, okay, any answers on question 8? I hope I haven't lost you guys. We have an option 1 from Jacqueline. Verushka, option 1 as well. So here's another formula for your formula sheet, which is put call parity arbitrage.
Hello, ma'am.
Yes.
Hello.
Yes, you can
Yes,
go
can I ask you
ahead.
something?
Sure.
Okay, this arbitrage profit or loss. So, where do we find these calculations on which unit, study unit?
Study. This is going to be chapter 13, Introduction to
13.
Derivative
Okay.
Instruments. Yeah. So today we're covering
Okay.
Unit 1, Unit 13, 14, and 15, right? So in Unit 1, we have our
Okay.
HP. Yes, yes. So in this one, we moved on to now
Okay.
Unit
Thank you.
13. Yes, there's a lot of formulas in Unit 13. You have your arbitrage, you have your option bounds, your break-even point. So yes,
Okay.
you can look at all your formulas in this chapter, right? Your option delta. So please have a look at all these formulas
Okay.
and these type
Okay.
of calculations. Okay.
Thank
Okay, so I have 5 of you who have answered. Any more takers? I hope none of you are lost if you guys are asking me which section this is. Is there anybody else who wants a little more clarification or assistance, or can we go to the solution? Okay, so let's look at our solution here, right? So the answer is option 1, 2 rand 62. And how do we do this? So this formula, if you are moving anything to and from, what you do is if you're moving anything to and from, just make sure you change the notation, right? So here's the formula, which is your call premium less your put premium, right? Which gives you 3 rand 50. And then over here you have your spot price, right? Less your strike price, but your strike price needs to be adjusted for the interest rate and the time frame, right? So we say 1 plus the interest rate, which is 12%, and you put it to the power of 0.25. Where do we get 0.25? They say the time frame is 3 months. 3 months is a quarter of a year, 0.25 of a year. So basically, if we say 3 over 12, we'll get 0.25. Remember your notation here, which is negative. So you say 1.12 to the power negative 0.25, right? Because we're bringing it back in time, right? That's why the negative is there. And we say we times by 40, we get 38 rand 88. 45 less 38 rand 88 gives you 6 rand 12 cents, right? So what's the profit? The theoretical side versus the actual side of payment. You say 6 rand 12 cents less 3 rand 50 gives you 2 rand 62. Okay. So that's how we get arbitrage profit. Everyone with me? Any questions? Any questions? Okay, let's move on to question 9. Looks like I'm going to be going to sports day early. No questions. So we have a theory question again. Which option trading strategy entails ensuring your stock position on the downside while still enjoying the potential on the upside? So which strategy would this be? So if you need to understand options and how it's going to help, not options, derivatives, these are market strategies which you can use to cover yourself in terms of an investment, where if the market goes up, you're protected. If the market goes down, you're protected. What can you do? Okay, any answers on the options? Already in the question, there's a clue. They say which option trading strategy? Option trading. Okay, we have some who are saying option 2. Looks like Sibosiso's load shedding hasn't kicked in, so we're very happy about that. Okay, everyone is going for a protective put. A protective put is that our strategy to help us, to assist us in enjoying the upside and protecting us on the downside. Let's have a look. Okay, you guys are right. If stock prices go down, the put serves as insurance. If you exercise and sell at the strike price, right? So if the market goes up, you're not going to use the put. You'll just lose the premium. But if stock prices go down, you have the protective put to sell at a certain price. Okay? So that's how the protective put works. To be able to sell at a certain price, but if the market goes up, you can sell at the higher price on the spot market. Okay, so let's go to question 10. A calculation for you guys on option bounds. Calculate the lower bound of a 9-month European call option of a non-dividend paying share, where the share price is 115 Rand, the strike price is 100 Rand, and the risk-free rate is 10% per annum. In an option bound question, you will be specifically asked option bounds, lower bound, higher bound, you'll be asked, right? So let's go ahead and attempt this question on option bounds. Someone wants to share a toast with us. Taking your classes. The class started at 9 o'clock. Okay, sorry about that, Sibosiso. Okay, so we have an option 4, 115 Rand. Calculate the lower bound of a 9-month European call option if the non-dividend paying share of a non-dividend paying share where the share price is 115 Rand, the strike price is 100 Rand and the risk-free rate is 10% per annum. Option 2, 21 Rand 90. Okay, so the formula for a lower bound is C greater than or equal to the spot price less the strike price times by 1 plus the interest rate to the power negative T. Okay, so I hope all of you have used the same formula. Let's have a look at the answer. Okay, so here's the answer. We say our spot price, right, the share price, the current share price is 115 Rand, less the strike price times by the interest rate, it's 9 months, so 0.75. So we say 1.1, which is 10% of our interest, to the power negative 0.75 gives you 93 Rand, 10 cents. So you say your spot price less this theoretical price, which we've adjusted for time here, gives you 21 Rand 90. Okay, so if we're researching our formula in the textbook while we're seeing this answer, what I'm saying to you is that put your formula sheet down so you don't have to go and search in your textbook. We don't have time for that, and you're not allowed to have your textbook in the exam. So a formula sheet will really help you, because just to reassure you, these formulas are all similar, and to double check that you know what, I'm on the right track here. Okay, everyone okay with option 2? Question 11. Share M has a standard deviation. Okay, so now I'm closing the chapter on chapter 13 and we're moving on to chapter 14, which is portfolios, right? So chapter 14 is a portfolio. So we're still dealing with shares, however, a combination of shares, right? So what is a combination of shares helps us to reduce risk, because we use the method of diversification. But now how do we do all our calculations with a combination of shares versus individual shares alone, right? So now the first calculation we're going to look at is share M has the standard deviation of 26%, while share N has the standard deviation of 14%. The covariance of the two shares is 0,032. Calculate the correlation coefficient of M and N. So these are how we calculate the risk and the relationship between these two shares, and then we decide on them for our portfolio. So here we are asking you to calculate the correlation, the relationship between the two shares in terms of performance. So can you please calculate for me correlation, and then after that we'll interpret the correlation between you and I. What does it mean? But the main thing is that you need to know how to calculate the correlation. Okay, so I seem to have been disconnected from my other device. Can someone maybe tell me what answers have we been getting?
Option 4 is the most popular.
Option 4. Okay, so people seem to be understanding the calculation of correlation. So let's look at the answer. So it is option 4. How do we calculate correlation? We use the covariance of the two shares over the standard deviation of the two shares, right? Now, I don't have a question, but you can get asked a question. What does this answer mean? 0,879, is it close to? Correlation can be any figures between 1 and -1, right? -1 being negatively correlated, +1 being positively correlated. So, in this case here, 0,879 is closest to 1, which means that share M and share N are positively correlated. But if we were sitting here by 0,036, it's still positive. They're still moving in the same direction, but not so closely like the way they are moving at 0,879. But ultimately, when you're forming a portfolio, you want negative correlation to achieve the best diversification, right? So that's what's correlation about. Let's move on to our next question, right? Which of the following strategies is a fixed income portfolio strategy, right? So what assets are fixed income? They are bonds, right? So a bond is a fixed income. You receive a fixed income every month, every year, or every month or every year. So which strategy is used in a portfolio for fixed income? Which of the following strategies are used in a portfolio of fixed income securities? Any idea? Can you assist me with the options, John? I can't seem to connect through my alternate device.
Oh, okay, don't worry, I'll tell you now.
Okay.
Option 4. Option 4, very popular.
Okay. So every time we doing bond calculations, we're doing yield calculations, right? So a yield spread analysis will definitely help us in terms of a portfolio strategy when we are investing in fixed income securities, right? An example of a fixed income security is a bond. This strategy involves monitoring, so yield spread analysis involves monitoring yields, looking for abnormalities, and then you adjust for these abnormalities. And once your normal spread is obtained, they use this spread to do future predictions, right? Future predictions which can result in profits. Last year, this is how they performed. So this year, let's employ this strategy here to make better profits. So you need to look at all your portfolio strategies for theory type questions. So let's go to question 13. Right, a portfolio consists of share A and B. Share A has a standard deviation of 20% and a weight of 30%. On the other hand, share B has a standard deviation of 10% and a weight of 70% in the portfolio. The correlation is 0,5. Calculate the standard deviation of the portfolio. So we've always been calculating standard deviation of an individual share that's from chapter 1. Now, how do we calculate standard deviation of the portfolio of the share? If you can please attempt that question for me.
Nothing yet.
Nothing yet. Okay, we'll give them some time. It's a long calculation, or generally longer calculation. Okay, I'll give you another minute.
Lindy, where says 4, option 4.
Option 4, 36.63, the state portfolio, a nice risky portfolio.
GD says option 4.
Okay.
Another option 4 from Lizzie.
Okay, everyone leaning towards option 4. Okay, so let's have a look at solution to 13. So I'm not too sure where everyone is getting option 4 from, but let's have a look at how we do the calculation, right? So, and then you guys, yes?
Desiree says option 3.
Option 3, okay. All right, so at least we got an option 3 from Desiree, but those ones with option 4, let's have a look. It looks like maybe, you know, we didn't complete the calculation, or, you know, maybe you didn't square root, because here we have, like the answer here, for standard deviation, we have to square root the final answer. So let's have a look at how you calculate standard deviation for the for the um, for the portfolio, right? So basically what you do is that you take the weight of the asset A, right? So the weight of asset A is 30% and the standard deviation is 20%, right? So you take the weight times by the standard deviation and you square it, right? Then you take the weight of asset B, right, which is 70% times by 10%, which is the standard deviation, and you square it, right? You square the options and you multiply them, right? Then you say 2 times by the weight of option A and the weight of option B, and then you times it by the correlation coefficient, you multiply by the standard deviation of option A and the standard deviation. So you do everything individually by the weight, then you times the weights, the correlation, and the standard deviation together, right? Once you get each of these answers, right? So first they squared each option, then they multiplied it, then they added it all together, right? Once you added it all together, I'm sure you get 36.63, or I'm not too sure, no, not 36.63, but you got to square root your answer. Once you square root your answer, you'll get 11.27%. So I'm not too sure if you guys want to tell us how we got this option 4, or if you guys are okay with the way we explained. It's not a complicated calculation. It's just a long calculation, and you must make sure you square each item, multiply, addition, and then complete the entire calculation to get your answer. Okay, so is everyone okay with that explanation? Let's go to question 14, right? Question 14 is from chapter 15. So in chapter 15, you have 3 types of measures, and we have 3 options there, which is in terms of the evaluation of the portfolio, we look at 3 types of measurements, right? So we have the Jensen measure, the Sharp measure, and we have the trainer performance index, right? So one of them you're most likely to get asked. So today I've chosen the Jensen measure, but however you need to know all of them, right? So evaluate the risk-adjusted portfolio performance of the mining and resource portfolio according to the Jensen measure, right? Assume the risk-free rate is 9%. So we have the mining average rate of return, standard deviation, and beta, and we have that of the market. So let's evaluate this portfolio in terms of the Jensen measure. It's also simple substitution into a formula, and you get the answer in terms of the Jensen measure. However, you need to know the Jensen, trainer, and Sharp measure, and how to substitute and calculate into the formula. So if we can go ahead with that, I can give you 2 minutes, and then we can look at the answer and conclude for today. Okay, any options for the last question of our presentation today or our class today?
Jacqueline got 2.13 and CD got 17.
17.
That's CD.
Okay.
Jacqueline says 2.13, and I think she's saying there's no option in there.
Oh, is it? Okay, so let's have a look at what Jacqueline is saying. All right, so the Jensen measure is your average rate of return less your sort of like a CAPM formula, your risk-free rate with your beta times by your market risk premium. And that gives us 13%. Okay. All right, so let's have a look at this. So the Jensen measure is your return in the mining and resources section, right, which is your average return less your risk-free rate, and the beta of the mining and resources section times by your market risk premium, which is market index less the risk-free rate. So which gives us 33 less 17. Oh, so there's a little bit of a problem in the, I missed that in the solution here. So it's supposed to be 30 minus 17, which gives us 13%. Yeah, 30 minus 17, which gives us 13%. This is just an error here, which says 33. Sorry about that. I will adjust it before we put it on. Okay, so Jensen formula, everyone okay with that? Who's the one who said there's no option in the... Sorry,
No, she
John?
changed her mind. She said option
No,
two.
no, it's number 2, but I put the option 2 and then with the
Jacqueline has her hand up.
Yes, Jacqueline?
Yes, my answer is number 2, and then
Yeah.
it's option 2, 13%. That's what I meant. There is a comma there. It's not 2.13.
Oh, okay, all right.
Or
No,
it's
that's
option
fine.
two, then
So long
it is
as
wrong.
yes. No, so long as there's no confusion, Jensen, all these measures are quite simple to substitute and solve for. Just please excuse this 33, which I'll adjust for before posting it. And yeah, so long as we're all on the same page and we understand the calculation and we can manage to do it when it comes up in the exam. So for today, I'd like to conclude and say thank you to you guys. This will be our last presentation. You have about 9 more days left for the exam. Please make use of our MyUNISA platform for any questions or any questions you'd like us to explain. I have uploaded a question for Unit 14 on the discussion forum, which was quite an interesting question I came across, and I thought you guys should have a look at it. It's also a potential exam type question, or just to understand things from a different perspective. So please go have a look at that. And if you can't get hold of me on the discussion forum, please email me at yumnagutta@gmail.com. I will post my answer. I'll reply to you and post my answer on the discussion forum so that everyone can look and learn from it. So from my side, all the best for the exam. And I think you're going to be well prepared. Like Dr. Nyamunda said last week, this is a subject which a distinction can be attained easily. So that's what I'm rooting for you guys. So please do us proud, and I hope you enjoyed these live classes, and I hope we can continue them going forward. Okay, thank you from my side. John, if you'd like to say something, and then we can close.
Okay, the only thing I want to say, ladies and gentlemen, is make sure you master the technology beforehand. Don't be struggling with technology in an exam. Make sure don't take chances. Go to a stable internet connection like what Yumna was saying. Make sure you know how it works. We want a distinction. We don't want to say because there was load shedding. No, distinction is coming. That's it from me.
Thank you very much. Enjoy the rest of your guys' day. And yes, communicate with us till the exam. On the exam day, obviously, please no communication at all. But yes, all the best. Take care. Enjoy. Bye.